Hello, everyone, and welcome to today's webinar on funding care in care homes, understanding the care fee cap and exploring available state assistance. For those who may not know, I'm Lisa and I've spent the last 12 years working in the care sector. During this time, I've had the privilege of supporting many individuals and families through the often challenging journey of finding the right care. It's a path I'm deeply passionate about, ensuring that everyone is fully informed before making such crucial decisions. Our webinar today is hosted by Athena Care Homes. We've got 7 care homes across East Anglia. We provide residential nursing and dementia care to many wonderful residents. We're committed to delivering the highest standard of support, not just for our residents, but also to their families. We're incredibly fortunate to have Nicky Cave from Eldercare with us today. Eldercare specialises in advising on care fee funding, and Nicky will be sharing her invaluable expertise with us. She will guide us through the complexities of funding care, explain the implications of the care fee cap, and shed light on the state assistance that might be available. Whether you're a family member of a care home resident, someone looking for care for a loved one, or a professional in the sector wanting to learn more, this session is designed to provide you with the essential information you need. So thank you once again for joining us. Let's dive in and make this a valuable and informative experience for everyone. Over to you, Nicky.
Thank you so much, Lisa, for that introduction. Let me know you can see my screen before you disappear.
We can, yes.
Excellent, thank you. So for those that have joined from home or using the remote link, don't panic if you can't put your cameras or microphones on. That's the way these webinars are designed. There is a Q&A box, but I can't see it as we go through. But if you still want to put any questions on there, Lisa can pick those up at the end and ask them of me. The event is also being recorded, so if it is information that you think would be useful to share with other family members, people that weren't able to log on today, then you will have that recording later, and do feel free to share that. So just to make sure you're on the right event, this is what we're planning to cover. As Lisa says, that road sign I think encapsulates the subject of care funding when you haven't had to deal with it ever before. So I'm going to try and make things a little less confusing and unclear and clarify who actually does pay for a stay in a care home. It's a simple question, but it does have quite a complex answer. We're going to look at the care cap and the system in general, whether that's going to be changing or not, particularly in view of the incoming general election. We'll look at whether a family home has to be sold, and we'll also just look at the options to prevent money running out if somebody is paying for care themselves. And throughout the presentation, you'll have our website address, but Lisa has, in your CRMs at Athena, have the contact details for ourselves. So if your questions don't get answered as we go through, obviously do feel free to get in touch and we can pick that up on a bespoke basis. Just before I start going through that agenda, which I hope looks at the sorts of questions you wanted answered, let me just give you a bit more of a background really to ourselves here at Eldercare. So we are a firm of IFAs, independent financial advisors, but we've been accredited by the Society of Later Life Advisors, which is really just an external audit, an external check of what we do, and somebody rubber stamping, gold marking, if you like, the fact that we do know what we're talking about in this particular area of later life advice. But lots of SOLLA members actually cover the spectrum really from, who's to say what later life is, but they might advise on post-retirement. Well, you could be retiring at 60. We specialise purely in care fees funding. So that's what we do all day, every day, chatting to families about how the funding works and what options they have. And it was set up in its current format back in 2007 by me. It's my business, as a result of my family getting absolutely no advice at all when my grandparents moved into a residential care home setting. We don't blame anybody for that. We didn't know what we didn't know. So we assumed we knew everything we needed to know. We assumed that they would be self-funding because they had a property, and we assumed we just had to pay for that care until the money ran out, and then have a chat with the local authority. It was really later in my career that I found out there were other options that could have prevented that scenario occurring. So I got on my soapbox and haven't got off since. And whilst we are here today at Athena's kind invitation, we have no commercial links with them or any other care provider. This is just about getting the right information, hopefully to the people that need it at the right time. We are having money conversations with families, so it's really important, particularly in this day and age, unfortunately, of scammers and untrustworthy people. You should check out and be able to easily find on the Financial Conduct Authority register anyone who you are taking financial advice from, and you will find us listed there. Very easy to find, Eldercare Solutions. So the beauty of this type of delivery, whilst not perfect, and some people, we were just talking earlier about the sort of face-to-face opportunity, this is wider reaching. So wherever you are in the country, wherever your family members might be who you could share the recording with, they could be on the other side of the globe and they would still have access to this information. We do the same with our actual client advice. We appreciate that siblings don't all live in the same place. Getting everybody together is tricky. So even when we're giving individual advice on a bespoke basis, that will often be done at arm's length using emails, telephones, Zoom potentially. Make sure everybody gets the right information and nothing is lost in translation. And because we do provide the advice remotely at arm's length, we can keep our costs down, so we can easily talk to family members or yourselves without having to charge you for that conversation. We can even research some of the financial solutions for you at our expense, not yours, because we have this low-cost business model. We're not a charity. We do get paid further down the line. If somebody takes out or purchases a financial product, for example, we would then be paid, but that's all disclosed and agreed by people at the beginning of that process. So going back to the agenda and looking at who actually pays for a stay in a care home, and I'm focused on residential care rather than care at home, but there is a lot of similarity. If we were trying to make it as simple as possible, we'd say that there are 3 possible funding streams for care. You might be paid for by the local authority, social services, the council, it's all the same place, so that comes under one stream. You might, as a second possible stream, be funded by our much-loved National Health Service. Otherwise, you are what's known as a self-funder, or some people refer to that as a private fee payer. So taking them in turn, when we talk about local authority funding, I think there's a perception, either we don't know anything about how it works, or if we do, we think it's linked to how much money you have or don't have. And to some extent, that's true. But there's really a step before that if somebody thinks that they should be in a care home or thinks their relative should be being looked after in a residential setting, there's actually a bar set by the local authority whereby you'd have to meet their care eligibility criteria first before any funding conversations take place. So in other words, if the local authority don't think that the person needs to be in a care home, they believe that person could have a support package at home, unless you can shift their view on that, there's no further conversation to be had. They'll simply say you don't meet our eligibility criteria, so we're not going to talk money at all. So it's not a given. So if my aunt, who's been recently widowed, thought that she would like to be in a care home and would feel safer and more secure in a care home, if she doesn't meet the council's eligibility criteria, they're not going to talk to her about any funding or support her in that choice. So it's a care needs assessment that has to be done first, and this is happening with a social worker from the adult social care department of your local authority. It's only after the needs have been assessed, really, that then a conversation about who's going to pay for it should take place. That financial assessment is more commonly known as a means test. So you probably heard that phrase. So that's the order. It's not ring up the local authority, they ask how much money you've got, then they do an assessment. No, they should do an assessment first, then talk about the money. What are they looking for when they're carrying out their means test? I'm sure if I could hear you, you'd be shouting this figure at me. It's to ascertain whether the person has above or below £23,250. That's the England and Northern Ireland limit. It's a bit more higher in Scotland, not that much higher. It's actually at its highest in Wales, where it's £50,000. And these limits are per person, so we can double them if we are talking about a couple. That 23,250 limit hasn't changed in about 10 years. So with the current rates of inflation we've had, that's very much a figure that's going down in real terms. There is talk well, it was supposed to happen last year. There is talk of it happening next year, that capital limit will go up to £100,000. Now, even if the current government stayed and we didn't have a general election, I think it's still questionable that would ever happen. I'm not entirely sure the government can afford to do it. And certainly if we get a different government, whether they would be able to honour that proposal remains to be seen. So if it does happen, it would be a big jump. You know, people being able to keep £100,000 rather than 23,000, but it really is watch this space at the moment, or watch our website, because we'll keep an eye on things and a narrative there. So when the local authority is doing this means test, what are they looking for? What constitutes capital? Well, pretty much everything, but there are three exceptions that I think are worth drawing your attention to that are quite common. If we are talking about a couple, it's important to note that it is only the person going into care who's assessed. The finances of the person staying at home, they don't come into it. So if the person at home has got lots of savings in their own name, that does not have to be disclosed. Any joint accounts or joint savings, however, then obviously 50% of the value does need to be disclosed within the means test, and all of it, you know, the 100% owned capital for the person going into care must be disclosed. So there comes a point at which it sort of makes sense for couples to equalise their assets, to have equal amounts, equally held, if you don't know which one of you might need care first. And certainly once we've got one person going into care, if there is a joint account, the person staying at home should take their 50% out, put it into an account in their own name. Don't mess with the percentage, but take out what's theirs so that it really clearly divides who owns what. There's a really good Age UK fact sheet around that. The other exception that's really worth mentioning, we assume everybody knows this, but so many people don't, and it's a big source of concern. Lots of people think that the house, the family home, the property would be included in the means test at some point if a spouse lives there, and that is not the case. If a spouse or a relative over 60, and there's a couple of other exceptions, if that's a genuine cohabiting relationship and one person moves into care, the property is disregarded. It's not they'll come back later and get the money. It doesn't exist. The only time this property would become part of that person's means test is if the spouse at home predeceases them, or the spouse at home also moves into care, or the relative over 60 moves out. You see where I'm coming. So it's just from the date that scenario changes that the house would form part of the means test. Otherwise, it never ever does. It's a completely disregarded asset in that scenario. The other exception may be affecting less people, but still affects quite a few, particularly if they've taken advice from an IFA at some stage in their life over the years. They could well have invested money in an investment bond, and if that bond includes an element of life insurance, that's also disregarded. So don't rush to cash it in. You can choose to cash it in, of course, but you don't have to. So it doesn't have to be included within the means test. So everything else really, your premium bonds, your national savings, your ISAs, your cash hidden under the bed or the floorboards, a holiday home, a second property, obviously, that might be rented out, business assets, they're all included in the means test to ascertain whether you have above or below. And even if you have, excuse me, even if you have below the capital limit, kind of doesn't stop there as far as the local authority is concerned. They will also assess your income, and they will expect you to put your income towards what they pay. And that's really important to note, because some people planning ahead think, well, we could self-fund for a couple of years, and then when the money runs out, we know that the local authority might pay £700. We could add mum's pension to that, and then she can still afford to pay £1,000 even if she's run out of money. That's not how it works, unfortunately. The local authority would expect her to contribute her £300 towards what they pay. So it's a combined contribution. You can't really retain your income, except if you have a spouse staying at home, they can retain up to 50% of any private pension, but you would be expected to put your state pension, the other half of your pension if you've got a spouse, all of it if you haven't, towards what the local authority agree to pay for you. Now, it will come as no surprise that the local authority will have a limit on what they'll pay, and it does vary authority to authority, but 700 is, I think, probably on the generous side as a national average. Maybe in the south, 700 could be more accurate, but it will be less than you might expect, unfortunately, because they do have a restricted budget, shall we say. Now, they can't just say, yep, you've got less than 23,000, we'll give you £700 a week, off you go and find a care home. Because lots of care homes might say, well, we don't accept 700 a week, our fees are a bit higher than that, particularly for perhaps the homes that you might want to choose. Now, the local authority actually has to offer a genuine, real life, non-fictitious care home place that will accept £700 if that's what they're offering to pay. So if they give you that figure, you would say to them, well, where is that place and how does that meet my mum or my dad or my uncle's needs? And you have to satisfy yourself that that's genuine. And if there isn't a place that will accept 700, the local authority has to pay more. There must always be at least one care home place offered that meets that person's needs, that no top-up is required. The local authority will pay for it, accepting what I just said about you having to contribute your income towards it as well. So top-ups, you'll hear that out there, I'm sure. Third-party top-ups, because top-ups can only be paid by third parties, except for one scenario that I'll come back to later. The occasions when a third-party top-up might be requested is that scenario I've just outlined, that the local authority come up with this genuine care home place for £700 and it meets mum's needs, but the family or mum doesn't like it. You don't have to go there. We can transfer the amount that the local authority will pay to somebody else, but that somebody else might want a top up if their fees are higher. Okay, so that's a legitimate request for a top up, is where you've turned down the no top up option, chosen somewhere else, a top up is then requested. That's legitimate, that's fine as far as the care home's concerned. The other time a third party top up could be required by them is if a person started off paying their own way, started off as a self-funder and then ran out of money. We would expect the local authority to step in and pay, but not necessarily at that rate for the reasons I've just outlined. If that happens really early on into a stay as a private fee payer and the care home didn't know that was about to happen, it wasn't discussed at the beginning, then they might be within their rights to ask for a top up. So this is really a sort of conversation to have when choosing a care home, ideally to just be clear on the care home stance so that this doesn't come as a surprise for anybody and nobody's asked to move, okay? But otherwise, as I say, there must always be a no top-up option available because not everybody does have a family member or friend who could pay a third-party top-up. So that's really your sort of local authority funding whistle-stop tour. We've got different people watching this at different stages of the journey, so I apologise if that was information that you already knew, but lots of people won't. So that's our means-tested system, our safety net system, and as far as I'm aware, there are no changes in any of the manifestos. I mean, the Lib Dems are talking about making it look more generous with free personal care, but if we do assume that this is a one-horse race, dare I say, Labour certainly haven't mentioned any changes of a negative or positive, actually, nature to the safety net system. What the Conservatives were due to be doing in 2023 were introducing, in addition to the safety net system, they were bringing in this care cap. They've already pushed it out a long time ago to October 25. I've left the question mark there, not general election related, because actually, again, Labour have put in their manifesto that they would still be introducing the care cap. And they haven't mentioned any changes to it, so one assumes it would be in the way that the Conservatives were going to be bringing it in. But even before mention of a general election, I was anticipating that this would never happen. The reasons it didn't happen in October 23 were money and resources, and I can't see that that will have changed by the time we get to October next year. So I'll tell you how it's supposed to work, but my expectation is it won't happen. The point of the next 2 slides is to prove that even if it happens, it's not, unfortunately, going to make the difference to you that it might sound like it does as a headline. So when this was announced, we are putting a lifetime cap on care costs, and they mentioned the amount. Everybody assumed that was all they would have to spend on care, and then it would be paid for. It's unfortunately the definition of care that's the problem. So I've already said to you, this is separate to the safety net system. It's not going to be retrospective. So any money that is spent on care between now and this ever happening won't count. And the cap had been set at £86,000. So as I say, people were literally thinking, if I put £86,000 to one side in my savings account, that will cover my care and I won't have to pay anything more. What they didn't realise that it was the local authority rate that will count towards the cap and not what the person as a self-funder is actually spending. So I'll give you this worked example in a minute that should hopefully bring it to make sense. And it is being recorded, as I say, so you can go over this a couple of times. But it's that definition that it's not what you're actually spending on care that counts towards the cap. It's what the local authority would pay for you if they were paying for you that counts towards the cap. And we have a big difference in those 2 figures, unfortunately. To make it slightly worse, they also said that some of what you spend on care is for board and lodging. It's for food and it's sort of hotel costs. So that won't count because that's not care. So rather than have the care homes work out what's for care and what's for board and lodgings, the government just said £200 a week is your daily living cost. That won't count towards the cap either. So let me give you a worked example, and I am using UK average figures here. I've not made these up completely. The average fee for a self-funder in a care home of choice is £1,300 a week. But if the local authority were paying for that care package, on average, they'll only pay £600 a week. So what does that mean for your care cap account? And literally your care cap account is something that you open up on a computer. If you meet the local authority's eligibility criteria, if they don't think you need to be in a care home, you can't have a care cap account anyway. So that's hardly fair. So it's literally a computer exercise that you open up this account and then they will clock up an amount each week according to this calculation. They'll say 600 is what we would pay for you if we were paying for you, minus the 200 hotel costs. So even though you're showing us invoices of 1,300 a week, only 400 of that will count towards the cap. So that's 900 that won't. What that means is it's going to take roughly 4 years from October 2025. So we're talking about the end of 2029 before anybody first rings that bell to say that they've reached the care cap. That's not quite as it was implied by a headline £86,000, because in reality, that person will have spent nearly £280,000 plus what they spend between now and then. Some of that's from savings, some of that's from income, but it's still a spend on care of much more than £86,000. So loads of people will have already run out of money and been picked up by the safety net system well before they reach the cap. Those that do still have money, perhaps somebody that started off with, 350,000 or 400,000, they reach the cap, although they've spent 280, not 86. Do they stop paying? Oh no, they still, if they've got assets, even when they reach the cap, they still have to pay the top-up cost of 900 and the hotel costs of 200. So all that actually happens is that they get given a direct payment, so they get given cash, if you like, to put towards the care of 400 a week. And they don't stop paying from their savings until they drop down to the 23,000 threshold. So it's absolutely not what the headline suggested it would be. So even if it happens, you really got to be aware of the shortcomings. If the local authority would pay a realistic rate of care, if they would pay 1,300 a week for somebody that they were funding, then of course this looks much more attractive, much more helpful. But I don't think that's going to happen anytime soon. They are not putting their rates of care up, and the gap is getting wider and wider. So all you need to take from this is that the care cap may not come into play. If it does, yes, it's set at 86,000, but the definition of how they arrive at these figures means you'll end up spending an awful lot more than 86,000, and you could still see your assets deplete to the 23,000. Oh, it's a cheery event, this one, isn't it? The second funding stream, this is almost a webinar topic in itself, and I am not an expert, but we know people that are. It is possible to get your care paid for in full, regardless of how much money you have yourself, by the National Health Service. And I'm sure some of you will have heard of NHS continuing healthcare, but it is not easy to get. They are not making it a simple application process, that's for sure. If you don't have any nursing care needs, if all your needs are met, even if they're significant needs, if they're all met by carers rather than nursing staff, then you won't get this. You might get it later on in your care journey, but be clear, you have to have healthcare need, and that needs to be the primary need that you have. Your healthcare needs should be complex, unpredictable, unstable, the sorts of needs that would otherwise be met in hospital, where it is free. Just because you're in a care home, if you have those sorts of needs, it should still be free. So again, I've got a really useful Age UK fact sheet that goes through the sorts of conditions that would qualify somebody for this support. If you just need a small amount of nursing care, rather than your primary need being healthcare, but there's still nursing of some sort, that's when you have the funded nursing care, which is 235 a week, help towards nursing costs. So if you're assessed for this, you'll end up falling one side of the line or the other. It could be that you just qualify for the funded nursing care to start with, but then if your healthcare needs deteriorate, become more significant, you could apply for this NHS funding. So somebody starting off as a self-funder, using their own assets, if their health deteriorates to this extent, then you might cross over to have the NHS pay for your care instead. But if you are not eligible for state funding because you have too much money, not eligible for NHS funding because you're not poorly enough, that's when you have to pay for the care yourself. And probably my only good news slide in terms of obvious state benefit is that you can, as a self-funder, claim or continue to receive a benefit called attendance allowance. The amounts are there on the screen, and they're two amounts according to whether you just need some help during the daytime or whether you need nighttime assistance as well. So lots of people think that this stops when you move into care, and often those people are just getting the lower rate. They think it stops when actually they could be applying for the higher rate, and it only stops if they become local authority funded. So it's a very underclaimed benefit still. It's a horrible form. They've made it, again, difficult to apply for, but if you just focus on they're just trying to ascertain if you need care or not, if you're in a care home, usually that's a given. So it shouldn't be too tricky for people to claim in that scenario. The only other state support really is for a category of self-funders in particular who have a property that is included in the means test ordinarily, so it doesn't have a spouse living in it or a relative over 60, but their other funds, their cash funds are low. They're under the 23,000 threshold. And actually that's a lot of people. A lot of people, the property is their main asset. Well, they might get some state support for, at the very least, the first 12 weeks of moving into care. So as I say, the property's got to be vacant. It's called a 12-week property disregard. It often these days doesn't even get mentioned by the local authority because this is a cost to them. This is money that they have to give out. So if you're moving into care permanently, you do meet the care criteria. So you're not having an argument with the local authority about whether you need to move in or not. If you meet the criteria and it's a permanent move, then for those first 12 weeks, if the value of the property is taken out of the equation, the other money is under 23,000, then you get state funding in the way that I outlined earlier, as if you are a state funded individual. So you still have to contribute your pension. They may still only pay 700 a week, but it's something. It might be a £300 or £400 a week contribution for 12 weeks, and you don't have to pay it back. So yes, there's hoops to go through, and again, they may try and tell you you can't go to that particular care home. You can, because you're a self-funder. You're just getting a bit of support for the first 12 weeks. During that period, the attorneys or yourself, you might have a think about, do we really want to sell the house? Do we have another option? And actually, it might be that the property's worth renting out, and that the rent that is obtained might be higher than you would get investing the money, for example. So it's a conversation that we're happy to have with families and talk through the pros and cons, because there are things to think about. There's income tax to pay on the rent, for example, void periods, all those sorts of things, but it might stack up. Now, those of you kind of thinking ahead might think, well, yes, that's all very well, but the rent plus the pension plus the attendance allowance, it still doesn't cover the fees. So we would have to sell. Or people that have thought it through have thought maybe they could get an equity release mortgage. Now, you can't get an equity release mortgage if the owner doesn't occupy the property. So if the owner has already moved out into care, you can't then go and borrow money against that property in the traditional equity release sense. You might be able to get a bridging loan, and that might serve a purpose. It comes with cost. But what you could do is use an equity release product that's in effect offered by the local authority. They call it a deferred payment or a deferred loan, but that is what it is. It's releasing equity from the property until you sell it. That could be for the short term, just from a cash flow perspective, to tide you over until the house is sold, or it could be for the longer term, so that that property is rented out for the duration of the care home stay. So all local authorities have to have a scheme available to their citizens. They could turn it down if there's already a mortgage on the property, or if it's low value, for example, but they have to have a scheme. They do charge interest, but it's less than a mortgage company would charge. You still have to meet their eligibility criteria. So if they don't think you need to be going into care, they won't lend you the money. But otherwise, you could apply for this as long as your other assets are under the threshold. And because you are a self-funder paying this money back to them, unlike the 12-week disregard when you weren't paying it back to them, they can lend the full 1,300 a week, 1,500 a week, or whatever you need. It doesn't get restricted to the local authority rate. So I'll put a charge against the property, and then it's just paid back when the house is sold. It should, as I say, follow on from the 12-week disregard, but lots of local authorities just kind of go straight into telling people about the loan and not telling them about the free money that they could have before that. So if you're in the scenario where there is a house and limited savings, absolutely this is worth having a conversation with us, just to get all your ducks in a row, to make sure you know what the local authority should and shouldn't be making available to you. But even with this option, lots of families decide, well, we'd have to sell it at some point anyway to pay back the loan, so we're just going to sell it now and get it over and done with. That then puts you into the sort of broader self-funding category. This is people who have got liquid funds, investments, maybe, as I say, house sale proceeds. They, in our experience, usually have two main concerns. If they're choosing a care home, how do they know what they can afford if they don't have a crystal ball? If they don't know how long mum or dad is going to be living in the care home, it makes it tricky to work out the forecasts for the cash and how long it would last, which leads them to their second concern, which is, well, if mum or dad does better than we thought they would do, which it often happens with a good care home, life expectancy goes up now that they're socially enriched, they're taking their medication on time, they're eating well, and so on and so forth, we literally can see amazing recoveries when people move into care, then the money might not last. And so it is that genuine concern as to what might happen. So we'll try and address those concerns. Of course we will, and we'll do some sort of basic cash flow forecasting, see how long the money would last. Maybe then they can talk to the care home as to, look, we've looked at the funds, we've got enough for 3 years, is that acceptable to you? Those sorts of conversations we can help facilitate. But where possible and where we think it would work, we'll put a solution on the table for the family, the attorneys to consider. And in our experience, it's a solution that about 85% of those self-funding families will never have heard of. So at the very, very least, you'll be able to log off this event knowing about it. Whether it works for your specific situation or not remains to be seen, but that's, again, something we can easily discuss with you and easily ascertain with you, just really in a 15-minute phone call. So the solution I'm referring to is a way of genuinely capping costs yourself, not one of those government care caps that isn't all it seems. This is a genuine way of properly capping costs yourself. It's not for everybody, it's certainly not for the faint-hearted. Large numbers are involved, but where it works for people, it literally gives peace of mind and takes away those concerns that I shared with you earlier. So at its core is a type of insurance. You can insure care home fees, but lots of people don't like the word insure. And also insurance, you normally think about that as being something you have to do well ahead of time, in advance. You can't buy your holiday insurance whilst you're on the plane. You have to insure your car before you get behind the wheel. Care home fees, you actually can't insure ahead of time. You can only insure as you move into care or after you've moved into care. So you actually have to have the need already and have the care home invoices coming through before you can insure those care home invoices. So the sort of Google search engine term, if you were doing online research, is a care fees annuity. Trips off the tongue. But people really misunderstand the word annuity, and that's because there is a pension or retirement annuity, and lots of people get the two confused. They might have heard of the pension annuity, and their general association with that is, oh, they're very expensive, oh, they're very poor value. Well, I disagree with that anyway, because at least they're guaranteed, but I can see where people are coming from with pension annuities. You have this huge, huge lump sum that you've built up over the years, all your working career. You maybe have a £500,000 pot, and then it converts to a £2,000 a month pension. And you think, well, how did that happen when I had £500,000? Well, it's because the insurance companies are going to look at you as perhaps a healthy 60, 65-year-old and assume that they'll be paying that income for the next 30 years, and that maybe you want it index linked, and maybe you want a spouse's pension added. So yes, it's a big amount of money, but you're asking them to pay out for 30 years. With a care fees annuity, it's the same principle, that you are paying a lump sum up front. Okay, you haven't built it up in the same way as you have a pension. It might come from your house sale, or it might come from your savings. So you're giving a lump sum up front to an insurer. They are then giving you a tax-free income for life and paying that directly to the care home. So they're similar in that sort of mechanics, but the difference is the care fees annuity purchaser is not usually in their 60s. They're usually in their 80s or 90s. They can't have a spouse's pension. It's just for them. And they are usually going to have some health issues. Otherwise, why would they need care? So the insurer paying out the income probably isn't going to anticipate paying it for the next 30 years. They might anticipate paying it for the next 3, 4, 5 years. So the cost or the size of the lump sum relative to the income that you get is much, much superior to what you'd get for a pension annuity. So similar, hopefully you can see those similarities. The difference is these policies are individually underwritten. So rather than just pulling a figure from a table, if I get quotes for 10 85-year-olds who all need an extra £40,000 a year to pay their care fees, to add to their pensions, etc. The prices that I get back from the insurance companies will be different for each and every one of those individuals, because each and every one of them will have had a different set of medication and a different history of health. Part of the underwriting also involves a conversation with the care provider if they're already in care, and that's all about what their day-to-day care needs look like. So it's a really bespoke, thought out quote for that person based on how long the insurance company thinks they're going to live. Now, they don't know, they don't have the crystal ball either. So this is a two-way gamble. The insurance company might get it wrong. The person might live much, much longer than anticipated. We had, unfortunately, a death notification just yesterday. The client had bought the plan 9 years ago. And I can tell you the insurance company did not predict a 9-year life expectancy. I think at the time it was 5. So the insurance company still had to pay for those extra 4 years. The family didn't. But of course, it could go the other way, that they might have bought a policy based on the insurance company thinking they were going to pay out for 5 years, and they ended up only paying out for 3 years. The family didn't get any money back. So it's about, let's use the term gamble. It's a casino, if you like, and it's a gamble on somebody's life expectancy. But actually, the alternative, which is pay as you go, putting the money in the bank or investing it somewhere, and investments can go up as well as down, which isn't always the right environment for somebody of this age. The pay as you go option comes with risk as well. What risk? Well, the risk that it could run out. And then what? Will the local authority agree to pay? Will they agree to pay for that particular care home? Will that care home take that rate of funding, and so on and so forth? So both types of funding are a gamble. Passing the risk to the insurer, you don't have to think about it again, but the money's gone. Or keeping the risk yourself, but in the event of longevity, the money runs out. This is for families to decide on a bespoke basis. It's not for us to say, we're just here to gather the facts. But if you are acting as power of attorney, your actual responsibility is to look after the future of the person who gave you that power, not to look after the beneficiaries. The care fees annuity is portable. So if somebody bought it for one particular care home, it's theirs. They can take it if they move. The report that we write when we've got all the quotes answers all these sorts of questions that you might be starting to think. It's a really preemptive report. We've written it based on questions asked by families over the last 20 years. They often ask, what happens about fee increases? So we get quotes with and without a built-in increase. We know care home fees will go up, but it doesn't mean you have to necessarily pay the extra money for your annuity to have escalation built in. You could just have the income paid out flat every year, provided you've got enough other money in the estate to cover the fee increases. But this is our job. This is our job to look at what's the best fit, what are the add-ons that you might want to consider. If you're a family who think, well, it's mum's money for mum's care, if we lose it, we lose it, you won't be bothered about capital protection. But for a family that's really struggling with that concept, well, we can look at ways to try and minimise the amount of money that you'd lose. So we can add on capital protection, it costs, or we can advise you on delayed start date annuities, which I won't go into now, but it's another form of capital protection where you just a bit like a voluntary excess on a car. You say, look, we'll carry on paying the fees for a year. We'll have the policy start in a year's time. It's cheaper to buy. And that just means you lose less money if something happens early on. The other question that's often asked, of course, is, well, what happens if the insurance company goes bust after I've given them all this money? Well, they are fully protected by the Financial Services Compensation Scheme. No 85,000 cut-off like you get with the bank. So this is proper, genuine protection and a full guarantee. So people used to buy these regularly to sort of ring fence capital and make sure there was something left for the families. But actually in this day and age, people are more concerned about the risk of running out of money and approaching social services, and social services not being able to afford to pay for them, or not being able to afford to pay very much. So you are opting out of ever needing a conversation with the local authority. If you buy one of these and it's set up correctly, you will never run out of money, so you don't need their support. If you're entitled to anything under the care cap, you'll still get it. And if you're entitled to NHS funding, then you don't need this anymore. You'll still get the money. It just is paid to you rather than the care home. So there's, a lot to take into account. The product itself might not be that complex, but these sorts of things, making sure that it's future proof, that's where you need a really, really experienced advisor that does this all the time. And there are very few, I can assure you. Most people do this, if they do it at all, as a sort of add-on here and there. So we are specialists. This is all that we do. And as I said at the beginning, we'd make no charge if you wanted to research this option. There's an annuity calculator that I'm going to signpost you to in a minute on our website that would give you a rough idea what one might cost, but we can do that with you over the phone as well. We're just paid a fee if a purchase is made, and that fee is already built into the cost of the quotes that we get you. We also have really good relationships with the insurance companies that offer these annuities because we're a specialist. So if there is a discount to be had, we'll get it for our clients. Legal and General and National Friendly, both of them used Eldercare to pilot their products when they came to market a few years ago. So we had an exclusive with them, but that's how much they trusted our advice to use us for the pilot. You cannot go direct to these insurance companies for care annuity quotes. You have to come through a broker like ourselves, and you only need one broker because we're going to go to the same four insurers. They're going to base their quotes on the same medical evidence, regardless of who asked for the quote. The difference is, aside from any discount we might be able to get you, the difference is your advisor's experience. And as I said to you, I honestly mean it, that we are one of, if not the only firm in the UK that does nothing but advice on this product and care funding. Others that do it, of which there are not many, will do it in addition to pensions advice or mortgages advice, investment advice. I would suggest you do your due diligence on the broker to use, making sure that they're easily found on the FCA register, SOLLA accredited, and have got really good independent client reviews. Ours are collected on Trustpilot. And then once you've made your choice about the confidence in advisor, let them go and do the whole of market piece, which is, as I say, those four insurers. So I've landed in closing on our website just because that page might be useful to you, the care fee annuity quote page. It's not asking for address and inside leg measurement. It asks for the person's age, how much income they have, what the care costs are, and it will give you a rough idea of what a care annuity might cost, subject to underwriting, but at least it gives you that sort of ballpark figure. Lots of other hopefully helpful information on there, including the news items where we will keep up to date on any changes to the care cap, or if Labour get in, what their plans are going to be that might affect you. So just favourite that, and you can revisit it when you need to. So that's your whistle stop tour of funding. It's quick on the mark to get back on screen there. I saw you. And hopefully that has enlightened you a little on those agenda points. Who actually pays for the care? Is it the local authority, the NHS? Is it you? Obviously, I've given you my view on the care cap. We've also looked at what state support's available for self-funders in terms of attendance allowance, 12-week disregards and deferred loans. When not a top-up can't be requested. And then we've looked at the care annuity as a potential solution that you might not have known about that could work if you are indeed a self-funder. Lisa, you can come back now. Yay.
Very
There you
keen to
are.
jump back in there, Nikki. Thank
You
you.
were. It's like literally being elbowed out of a room. The online elbow.
Thank you so much for that, Nikki. It's informative as ever. Since the 8 odd years ago we first started talking about the care fee cap, the news doesn't get any better on it, does it? If it ever comes in.
Exactly. I just saw a quick question there, which is easy to answer, and a very good one from Judy, which is just saying, can you insure, i.e. can you buy the care annuity to pay for care at home? Absolutely you can. They are sometimes less affordable because obviously in a care home you're paying an all-inclusive fee, whereas care at home you've got all your bills etc. on top as well as the care costs. So some families use equity release to sort of part fund the annuity. The only issue is that if somebody has a self-employed carer, the money can't go direct to them from the annuity. It has to be paid to mum or dad and then it's taxed. If the care home is being provided by a CQC registered care agency, then it can be paid direct to them tax-free, the same as it can be paid directly to the care home, who pretty much all of them are CQC. I don't think I've ever come across a care home that's not CQC registered, not in the last 20 years. So yes, it can be. It just is a slightly more complex texture to it, because somebody might have to use equity release to be able to afford to buy one unless they've got substantial savings. So hopefully that answers that question from Judy.
Perfect. Thank you so much, Nicky.
No worries. Did you have any questions, Lisa, that anybody asks you that wasn't covered in that, or any questions that were submitted before the event that we won't have covered? I think hopefully we've designed the webinar to answer everything as best we can.
Yeah, we did have a couple of questions, but as you said, they've been kind of covered off already in the information you've given.
Brilliant, brilliant. Excellent. Well, without further ado, if you're happy, we can end the webinar. A recording will come through, and that can be circulated to the online attendees and obviously to the CRM. So the people that have come in person, they can then just request a copy of it from the CRMs at the homes. Yeah.
Super. Right. Thank you everyone for joining us today. We hope it's provided you with a clearer understanding of the complexities surrounding funding care in homes. It's not a straightforward subject, which is why we've built up a relationship with Nicky over many years, so that we can rely on her good advice to support us through difficult conversations. Athena, we really believe in making sure that people are well informed, and that it's key to making the best decisions for loved ones. So we hope that you've been equipped with the knowledge and insights you need to navigate this very important aspect of care. And as Nicky said, if you have any further questions, please do get in touch with us or with Nicky directly, and we'll all be happy to support you.
Thanks ever so much for organising. Thanks, everybody.
Thank you. Bye-bye.